Silver just shot up big, 22%, in a single day. Yesterday it hit 65, and today it's trading around $78 per ounce. Spot silver is at $77.16, and markets are buzzing. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe, and now let's get back to the market update just a couple of hours. The Dow hit a new all-time high, up 950 points, and both the Nasdaq and S&P 500 fully recovered from yesterday's sharp drops. Shanghai silver is even higher at $82. Here's the thing, you probably wouldn't notice this if you were only reading mainstream headlines. The bounce isn't small, it's huge, and it's happening across almost all risky assets at the same time. Bitcoin jumped 17%, Ethereum rose 18%, and over $550 million in crypto shorts got liquidated. In the last 20 hours, $3.04 billion poured into crypto markets, while small-cap U.S. stocks, like the Russell 2000, added nearly $100 billion and are now fully green after yesterday's slump. This shows one clear trend. Investors are moving back into riskier assets fast. Small companies and altcoins are reacting quicker than the big players, which is a classic sign of a risk-on market. Bitcoin dropped nearly 35% over the past 3 weeks, yet many altcoins actually gained, showing higher risk investments can bounce even when the big names stumble. The pattern is obvious. Stocks, metals, and crypto crash and recover day after day. All through 2026, we've seen this over and over. At some point, it's no longer just volatility. It's clear the markets are being manipulated. News, history, everything, it's all skewed. But the truth eventually surfaces. Now, let's focus on silver. Did the former J.P. Morgan Metals chief just call the bottom? Some posts suggest he might have. Remember this, market corrections don't kill bull runs. Blind consensus does. The London silver lease rate just jumped to 6.1% for 1 month. That's a huge clue about what really happened in the recent crash. This wasn't a collapse in physical demand, it was leveraged paper positions getting wiped out. If silver were easy to get, professionals wouldn't be paying top rates to borrow it. A 6.1% lease rate means physical silver is tight and getting tighter. The Silver Kivol Index, which measures volatility, is at 106.35 and rising. Silver is also still in backwardation, meaning the price for immediate delivery is higher than future contracts. This tells us that real silver is scarce. When silver prices are kept artificially low, the physical metal disappears fast. What does this mean? As speculators slowly trickle back in, open interest will grow along with the price. Day-to-day swings happen, but the low points are likely already behind us. Prices should trend higher in the weeks ahead. China is also a major player here. Since 2020, Chinese exchanges have drained roughly 6,600 tons of silver, a 90% drop in 6 years, which is about 30% of the annual global silver supply. Physical silver demand in China remains strong. Today alone, 73 tons were withdrawn from SHFE SGE vaults. If this pace continues for just 11 more days, their silver reserves could run out. Chinese buyers are stacking silver while prices are low. Because China is the world's largest consumer of gold and silver, this trend could push global markets into a serious supply crunch. On top of that, geopolitical tensions are heating up. Iran refuses to halt nuclear enrichment during talks with the U.S. And right after the negotiations, the U.S. slapped new oil sanctions on Iran. This kind of risk usually pushes investors into precious metals like silver and gold. If you're panicking about silver right now, you're probably looking at the wrong time frame. On a long-term chart, the recent pullback is just a retest of a previously broken range. Prices haven't even crossed the 2011 highs yet, but some people are already writing off silver. The truth, there's still plenty of steam left in this rally. Big moves in markets are never easy. Silver's been through wild swings. But if you focus on the fundamentals and keep common sense, the short-term pain is much easier to handle. The big picture matters more than day-to-day panic. Now let's talk about silver miners. They're the real story for 2026. Recently, silver surged over $120 per ounce before pulling back to around $70, but miners haven't fully caught up yet. Historically, during bull markets, silver miners outperform silver itself. From 2002-2011, silver rose about 300%, while top miners like Pan American Silver soared 1,500%, that S 5 times the metal S gains. Even average miners usually deliver 3 times the price movement of silver. In 2025, silver ripped higher, but miners barely kept pace. Analysts were still valuing them based on outdated $35–40 silver prices. That's why 2026 could be a huge turnaround. Big miners will start reporting earnings soon, and many will show explosive cash flow. Even at lower silver prices than today, a 10 million ounce a year producer could see profits jump over 1,200% from previous quarters. Once these numbers hit, analysts will have no choice but to upgrade valuations fast. Look at gold miners for precedent. Gold climbed from $1,300 in 2019 to highs around $5,500, and miners lagged at first. But once the market caught up, their gains exploded. Silver miners are following the same playbook. There is another key factor: banks don't have unlimited balance sheets to keep trading metals. Bloomberg points out that structural limits exist. They can't suppress silver prices forever. Once physical demand overwhelms paper supply, prices have to adjust. Now let's look at the COMEX March silver situation. In just 21 days, 429 million ounces of demand could hit against only 103 million ounces of available silver. That's a serious mismatch. If the delivery rate stays at January-February levels, around 50–70%, then we could see demands for 200–300 million ounces against just 85–103 million ounces available. This is the core problem as of February 5, 2026. Looking closer, February 2026, delivery rate 98%, 18.72 million ounces delivered from 19 to 11 million open interest. January 2026 deliveries 49.4 million ounces, over 7 times the 2024 level. Silver inventory is draining at about 785,000 ounces per day. If March sees even 25% of contracts standing for delivery, COMEX could require more silver than they have on hand. That's why some analysts are asking if a COMEX silver default is just 3 weeks away. At the same time, Bitcoin could still face more downside. Historically, every major Bitcoin bear market over the past 14 years saw drops of at least 75% from highs, with some lows reaching 93%. Trend analysis suggests the next bottom could be around a 70% drop, putting Bitcoin near $38,000. The silver-gold ratio often tracks Bitcoin's moves. For silver and gold to stabilize, Bitcoin may need to pause or build a base first. Until then, downside risk for silver remains. Even with silver bouncing 22% from $65 to $78 and Bitcoin reclaiming $70,000, technical charts suggest more volatility could come. This doesn't mean the bottom isn't near. It just means we need confirmation before calling it all clear. Perspective matters. In mid-December, silver was at $65 with extremely bullish sentiment. Now it's the same $65, but sentiment is bearish and RSI is oversold. Same price, totally inverted psychology. Markets can stay oversold longer than expected, especially during fast deleveraging events. The 47% crash in 7 trading sessions shows how quickly sentiment can swing. Violent drops often lead to violent rebounds, but remember, often doesn't mean always. Gold's long-term uptrend is still intact, which suggests the broader precious metals bull market isn't broken. Silver, however, needs to hold current levels and build a base before we can confidently say the low is in, instead of it being just a temporary bounce in a larger correction. Structural indicators are pointing to exhaustion in selling pressure. COMEX gold open interest is the lowest since December 2018. Silver lease rate remains high at 6.1%. Backwardation continues. China's silver vaults are draining fast, 73 tons in a single day. At this pace, just 11 days could empty them. Right now, COMEX has only 103 million ounces registered versus 429 million ounces of exposure. February delivery rate was 98%. These aren't signs of oversupply. They're signs that leveraged paper positions are being flushed while physical demand remains strong. Here's the takeaway. 1. Risk on is back and fast. Silver jumped 22% from $65 to $78. Bitcoin added $11,000, reclaiming $70,000. Crypto markets gained $340 billion today. U.S. stocks added $1 trillion in just 2 hours, with the Dow hitting an all-time high and the Russell 2000 fully recovered $550 million in crypto shorts liquidated. However, Bitcoin's technical structure suggests historical patterns could bring more downside, potentially down to $38,000, so more volatility is possible. Confirmation is still needed before calling a market bottom. 2. Silver fundamentals remain tight. Lease rate at 6.1% signals this was a paper leverage flush, not a collapse in physical demand. Silver CVL is at 106. Backwardation continues. COMEX gold open interest is the lowest since 2018. China is draining silver fast, and speculators will rush back in as prices rise. 3. COMEX March crisis looming. 429 million ounces of open interest versus only 103 million registered. January deliveries were 7x higher than 2024. Current drainage rate is 785,000 ounces per day. If March sees 50-70% delivery standing, demand could hit 200 to 300 million ounces against 103 million available. Silver miners are reporting earnings this month, and many will show explosive cash flow due to higher prices. Historically, miners can deliver up to 3 times the movement of silver itself. Analysts will have to upgrade valuations fast. Banks have limits. They can't suppress prices forever. Physical demand versus paper supply will eventually force repricing. So where does that leave us? Did silver hit its low at $65 with this 22% bounce confirming it? Or is this just a temporary relief rally before Bitcoin completes its historical 70% drawdown, potentially taking silver lower again? The truth is, it's too early to be certain. COMEX data tells us the structural tightness is extreme. Registered silver is just 103 million ounces versus 429 million ounces of exposure. China's vaults could be empty in 11 days at the current rate. The lease rate remains high at 6.1%, and backwardation continues. Meanwhile, silver bounced 22% from $65, so clearly there's strength returning to the market. But the key is timing. Risk on came back fast and hard, but you need to know your time frame. Short-term volatility is likely to continue. Silver and Bitcoin could both experience ups and downs before a clear bottom is confirmed. The smart move? Invest with logic, not hype. Base your decisions on data, fundamentals, and analysis, not fear or excitement. Keep perspective. Look at long-term trends, supply and demand dynamics, and structural pressures in the market. That's where strength comes from. Understanding, not emotion. Silver's story in 2026 isn't over. Physical demand is strong, miners are just starting to catch up, and the COMEX could be pushed to its limits in March. Bitcoin may still test lower levels, which could pressure silver temporarily, but the long-term picture for precious metals remains bullish. If you focus on the fundamentals, stay patient, and keep perspective over noise, you can navigate these markets successfully. The swings are big, yes, but that's the nature of one of the largest games in human history. Silver, gold, crypto, and risk assets are showing us one thing. Volatility is normal, but informed investors turn it into opportunity.